Federal Reserve Chair Jerome Powell made a highly anticipated address at the Fed's annual retreat in Jackson Hole, Wyoming, where he laid the groundwork for potential interest rate cuts in the near future. This announcement has sparked considerable discussion among economists, investors, and policymakers alike as they try to decipher what this could mean for the U.S. economy moving forward. Powell's comments were measured, yet they signaled a pivotal shift in monetary policy, reflecting the Federal Reserve's evolving outlook on inflation and employment. In his keynote address, Powell stated, "The time has come for policy to adjust." While he declined to provide exact indications on the timing or extent of the rate cuts, his words made it clear that a change in direction is on the horizon. This statement marks a significant moment for the Federal Reserve, which has spent the last several years aggressively raising interest rates to combat inflation. The path ahead, Powell emphasized, will be guided by incoming data, the evolving economic outlook, and the balance of risks. This cautious approach underscores the Fed's commitment to a data-driven strategy, ensuring that any policy adjustments are made with the broader economic landscape in mind. The backdrop to Powell's speech is a series of 13 rate hikes implemented between March 2022 and July 2023. These hikes were part of the Fed's aggressive campaign to bring down inflation, which had surged to its highest levels in over 40 years. Powell took considerable time during his speech to reflect on the factors that led to this inflationary spike, providing a comprehensive assessment of the challenges the U.S. economy has faced. However, Powell did not dwell solely on the past. He also acknowledged the progress that has been made in taming inflation, stating that the Federal Reserve is now able to focus more equally on its other mandate, maintaining full employment. Inflation has declined significantly, Powell noted. The labor market is no longer overheated, and conditions are now less tight than those that prevailed before the pandemic. These remarks highlight the Fed's confidence in the strides made towards stabilizing prices and ensuring a robust labor market. As Powell delivered his speech, financial markets responded immediately. Stocks added to gains, while Treasury yields dropped sharply, reflecting the anticipation of a shift in monetary policy. Traders, already expecting a potential rate cut in September, adjusted their predictions to consider the possibility of a half-point reduction. The CME Group's FedWatch tool showed a 100% chance of at least a quarter percentage point rate cut in September, with the odds of a half-point cut rising to about 1 in 3. This market reaction underscores the weight of Powell's words and the influence the Fed's decisions have on the broader financial landscape. This was a valedictory of essentially Chair Powell turning the page, saying the mission, which has been focused on inflation for the last 2 years, has been successful, said economist Paul McCulley, the former PIMCO managing director, during a segment on CNBC's Squawk on the Street. His comments reflect a broader sentiment that the Fed's aggressive rate hikes have achieved their intended effect, allowing for a potential easing of monetary policy. Despite the progress, Powell was careful to temper expectations, acknowledging that the inflation rate, while consistently declining, has not yet reached the Fed's 2% target. The most recent gauge, preferred by the Fed, showed inflation at 2.5%, down from 3.2% a year ago and well below its peak above 7% in June 2022. While this downward trend is encouraging, Powell emphasized that the Fed's work is not yet complete. One of the more nuanced points in Powell's speech was his analysis of the labor market. While the unemployment rate has slowly climbed to 4.3%, a level that might traditionally signal a recession, Powell offered a different perspective. He attributed the rise in unemployment to an increase in labor force participation and a slower pace of hiring, rather than widespread layoffs or a deteriorating job market. This distinction is crucial, as it suggests that the labor market remains fundamentally strong despite the rise in unemployment. Our objective has been to restore price stability while maintaining a strong labor market, avoiding the sharp increases in unemployment that characterized earlier disinflationary episodes when inflation expectations were less well anchored, Powell explained. This balanced approach highlights the Fed's dual mandate and its commitment to navigating the complex trade-offs between inflation control and employment. As the Fed prepares for its next steps, all eyes are on the September meeting, where markets expect the first rate cut in this new phase of monetary policy. However, Powell did not commit to a specific timeline, leaving the door open for adjustments based on forthcoming economic data. Minutes from the July Federal Open Market Committee meeting indicated that a vast majority of officials believe a September cut will be appropriate, provided there are no major surprises in the data. He's pretty dovish. He bought the option to do whatever he needs to do next month, which is clearly an ease, said Joseph Livornia, chief economist at SMBC Nikko Securities. I don't think the bar for 50 basis points is particularly high. Livornia's comments underscore the flexibility Powell has built into the Fed's current strategy, allowing for a range of policy responses depending on how the economic situation evolves. Powell also took time to reflect on the lessons learned from the recent inflation surge, which he described as a global phenomenon. He pointed to factors such as rapid increases in demand for goods, strained supply chains, tight labor markets, and sharp hikes in commodity prices as key drivers of inflation. His acknowledgement of these global forces highlights the interconnected nature of modern economies and the challenges central banks face in managing domestic inflation within a global context. In a lighter moment, Powell quipped about the early days of inflation, when he and other central bankers referred to it as transitory. The good ship transitory was a crowded one, he joked, eliciting laughter from the audience. This self-reflective moment served as a reminder of the unpredictability of economic trends and the humility required in economic forecasting. Powell concluded his remarks by reinforcing the Fed's commitment to its core mission. The FOMC did not flinch from carrying out our responsibilities, and our actions forcefully demonstrated our commitment to restoring price stability, he said. An important takeaway from recent experience is that anchored inflation expectations, reinforced by vigorous central bank actions, can facilitate disinflation without the need for slack. However, Powell was also clear that the Fed's journey is not over. There is still much to be learned from this experience, he noted, acknowledging the ongoing challenges and the importance of remaining vigilant as the economy continues to evolve. As the financial world digests Powell's remarks, the key takeaway is that the Fed is poised for a shift, but the exact timing and magnitude of that shift remain uncertain. Investors, policymakers, and the public alike will be watching closely as the Fed navigates this next chapter, with the future of the U.S. economy hanging in the balance.